Good afternoon. It's Anthony Mento here. To our folks on the East Coast, good morning. To everyone out west, we are kicking off our 12 o'clock bi-monthly webinar on a fairly timely topic of de-risking portfolios using cash value life insurance. So the marketplace is ever evolving. And we are trying to keep our agents on top of rapid changes in underwriting, product pricing, execution of businesses, and business continuity of the insurance company. So hopefully today we'll give you a strategy. We're going to showcase a software build that we've automated to help you scale this concept in the event it is appealing to you and some of your clients. So we're going to actually, today's call will be recorded. We'll also send out handouts to the slides. In the control panel, you will actually be able to type questions. In an effort to conclude this call at 12:30 sharp, we're going to ask you to type your questions. Promise to get to every question on that list, whether it be within the 12:30 allotted time frame or not. We'll reach out to you one-to-one and answer that question that you may have. So for today's agenda, we are going to spend 30 minutes broken out in the following ways. 5 minutes to introduce a software solution to help quantify your story. 15 minutes on distribution rates in retirement, 10 minutes on non-med cash value life insurance, and then a 5-minute question and answer. So very quickly, we have some extra time on our hands here at Life Brokerage to build content and to build tools that are helpful for you. And we've enrolled the help of our programmers and our financial minds, and we've come up with a financial model here that shows an existing client or new prospective client on how to create a volatility buffer in volatile markets. So a few weeks ago, we spoke on this strategy in a webinar, and we showed how we can use whole life insurance as a family bank in opportunistic times. And boy, was that impactful, particularly in today's market, where we've had several clients who already implemented that strategy jump into the market somewhere on or around March 18th, 19th, and have experienced double-digit growth thus far. So we feel as though cash is king, and having a piece of your portfolio in cash or cash value life insurance makes you all that more stronger, particularly in volatile markets. So what you're looking at here is a 21-column analysis, which you're probably having a hard time seeing, and I'll break out a little further in segments. But this prints extremely well on 11 by 17 cardstock paper if you're visiting with a client. So here goes. No diversification. Okay, you're riding the highs and lows of the market. Software asks for the value of the portfolio. You allocate 65% equities, 35% bonds. You can actually get true allocation from your clients. And we can model this with a high degree of accuracy. So 4.2% on equities using a blended rate of 30%, after tax 4.2%. So that's 6% pre-tax growth rate. Bonds, very simple. Bonds are cash equivalent. 35% of the holdings, you see 350,000 on $1 million. I think it's pretty self-explanatory on where the portfolio is going. Column 6. This is where we get to the meat of our conceptual discussion. It is mathematically improbable to distribute. Forgive my my coloring here of my pen. I'm posted up in my 9-year-old daughter's bedroom with dual monitor and a fuzzy office chair, so it's quite comical that the pink and purple pen comes out at the most appropriate time. So column 6, 3.5% distribution rate on whatever your portfolio grows to at retirement. So we think of this as a mountain. You're going up the mountain in accumulation, and then you're coming down the mountain in retirement. Okay, 98% of wealth advisors focus on the up. You get to the top of the mountain, and then you're kind of left to figure it out from there. All probabilities suggest if your portfolio is going to last 30 years into retirement, given market volatility and sequence of returns, and if you retired in 2020, you know about sequence of returns. It's a poor sequence to start while the asset values were at its peak. That's troublesome. So mathematics suggest 3.5% is the distribution rate that you can afford to take from your portfolio value for the rest of your life without running the risk of you outliving your assets. So hopefully that makes sense to you. What that means is 3.5% on 1.6 million is $58,000 in retirement income. Somewhat straightforward. We're going to advance. No diversification. Here we go. Retirement age 66. Here's your $58,000 every year running out through age 100, and the software models this. All plug and play. Takes you the duration, $58,000, and here's your cumulative income. By age 90, you've received cumulative income of $1.4 million, and this is taxable. So this is ride the markets, do nothing, no diversification. This is the conventional approach. And this is really important to show with clients because this is what everybody does. Now we're going to take them down a different path. Now is not the time to retreat from equities. In volatile markets, and I'm going to support this theory with data in the upcoming slides, now is not the time to retreat from equities. You do not want to sell and lock in your losses. You know, consumer behavior is the biggest enemy in poor performing portfolios or missing the most important days of the market. Okay, if you fled upon the first signs of distress, you missed yesterday, the day before, and the day before that. So we had 3 consecutive up days. You cannot time the market. You will not guess the top. You will not guess the bottom. But what you can do is position yourself in a way to buffer against volatile markets, and that's the key word. There are 3 types of buffers. Dr. Wade Pfau from the American College stressed this until the cows come home. You've probably seen his articles or his books or his teachings in the RICP course at the American College. There are 3 types of buffers: cash, reverse mortgages, and cash value life insurance. So again, remember, it is not the time to retreat from equities. So what we want to do is retreat from bonds. Okay, bond yields are poor. The bond markets are turbulent. So what we're looking to do is take 1/10, just 1/10 of your bond allocation and move it into cash value life insurance. You see very clearly here, $350,000, 1/10 translates to $35,000. Your flavor of choice makes no difference to us, but we're recommending something with a bottom. Whole life or low cost, low charges, indexed universal life. Asset-based IUL does not work in this strategy. So what I'm showing you here is a supplemental income model. There's 2 models here that I'm going to showcase. The supplemental income model means you continue to take 3.5% of your portfolio value or whatever left in equities. Okay, in this instance, $1.2 million. You're still able to take 3.5% because that is the mathematical distribution rate that will last you 30 to 35 years into retirement, subject to market volatility. Plus, you will have roughly $600,000 in cash value life insurance, in which you can take $32,000 of tax-free income per year. So you have $44,000 from your portfolio, which is 3.5% of 1.2 million, and take $32,000 from your $600,000 of cash value life insurance, which gives you $76,000 of annual income. almost, let's call it 40% of that is income tax free. So I'm going to keep going in this chart. Diversified portfolio. This is the combined approach using the supplemental income model. And I'm taking you year by year. Remember, supplemental income model, life insurance cash value distributions of $32,000, 3.5% of the portfolio asset. We literally take an X and draw through the remainder of the portfolio value because it just does not matter. Most models are flawed in that they show static returns year over year, which is not reality. Markets will go up, markets will go down. It doesn't matter. If you can tell the distribution rate story, once you get to the top of the mountain, you will be able to position actuarial-based products, cash value life insurance, or income annuities in a much more successful fashion. So what I'm showing here is cumulative income of $2.6 million by age 100 using the combined 3.5% distribution rate from equities and the supplemental income model. What supplemental income model means is that every year you will pull from the cash value life insurance, just like we typically sell, pay premiums for X amount of years, take income for Y amount of years. Now, it works, it's successful, it's easy to explain. But, well, let me give you the result here. We're going to result in an extra $450,000 of supplemental income. Majority of the income, remember, 40% of the income that we've taken in the supplemental income model is income tax free. So let me get into the buffer model. This is where we start to implement Dr. Faust strategies. Buffer model shows similar concept, except no income from the life insurance policy. The only years I will take the income from the life insurance policy are the years following a down market. The years following a down market. I will not take systematic supplemental income from the life insurance policy. So what that means is that I can take more aggressive distributions where I'm going to cross out the 3.5% distribution rate model, and I'm going to change that to 6%. And I'm able to take a 6% distribution rate because I had this cash value life insurance buffer. So I'm not showing annual income. I don't know. I can't predict when the market's going to go up, when the market's going to go down. But the change here is that I'm going to take 6% of my portfolio value of $1,275,000 and grab $76,000 from my portfolio rather than $58,000 in the 3.5% distribution model. So let me take you through this again. Market goes down in 2020. We have a negative return. I do not retreat from equities. I give them a chance to rebound. And in 2021, I'm going to supplement all or portion of my retirement income from this life insurance policy. If the market goes up in 2020, I'm going to take from my equity portfolio because I have gains. So it's that simple. I'm creating staying power in my portfolio using a buffer model, which involves cash value life insurance. So here we go. We keep going with this. Buffer asset, $76,000, 6% distribution rate, far better than the do nothing approach. At age 90, similar result, $449,000 of additional income, right? Retirement income distributions, plus I carried a whole bunch of death benefit, and I had staying power all along. Mathematically, the buffer model creates a much higher probability for success than any other models we've tested. And here's why. Sequence matters, right? You see a lot of negatives here, but almost immediately following the negative is a positive. You cannot miss those positives. You cannot take flight in market volatility and miss the upswing. your portfolio will not generate the rates of return that you need to accumulate enough assets to be able to afford to retire. In other words, you won't get to the top of the mountain without staying power. You got to stay in the markets. We have a great piece that describes sequence of returns. We'll show historical performance. We'll reverse the actual performance, and we'll show you, okay, what happens on the way up, and then conversely, what happens on the way down. And what you'll find is that on the way down, sequence really matters. It means nothing on the way up the mountain when you're accumulating. If you can average 8%, it doesn't matter the order. You're still going to get to the same result. Conversely, you catch a bad sequence like we're living right now of a -9, -12, -22, you got nothing left by age 78. If you catch a good sequence, wow, you're partying, right? You house on the lake, vacations, SUVs. I mean, that's the good stuff. So, where are we going with this? We're going to tool number 2 that we were able to build out for you in our quarantine. This is a plug and play distribution model. You give us the age, you give us the number of years you want to see the analysis. We'll give you the actual return in the actual S&P for that given period, and then we'll reverse it. Just like the sample piece we showed just in the slide ahead. There are some insurance companies that have a good static piece that explain this concept. AXA does a nice job. Mass Mutual does a nice job. Your sequence of return matters. To find a model that actually can be customized in your colors, in your logo, to a specific client in a specific period, we can provide that to you. This has been built. There's tons of third-party content, right? We don't want John Hancock or Lincoln or Mass Mutual telling this story because there's motivation to sell actuarial-based products. We're going to use third-party content from J.P. Morgan and Merrill Lynch and Morningstar and Vanguard. We want to use the industry to help tell our story. This is a piece from BlackRock. 7% on the way up, Mrs. Jones, Mr. Smith, Mr. Brown. They all got different returns. They all got 7%. They all ended with $5.4 million. Pretty cool, right? Like, pretty cool. Didn't matter the sequence. They all got 7%. This is BlackRock telling you the story, not me, not the insurance guy. Look what happens. Look what happens on the way down, distribution phase. This is my favorite piece. This is my very favorite piece, and this supports why we're showing a volatility buffer concept using a 6% distribution rate. So, how many assets do you need given different allocation classes to generate $100,000 of lifetime income? This proves concept that it's not the amount of assets you have at retirement, it's the type of asset that you own and the distribution rate required to fulfill your lifestyle. So, here we go very quickly. If you have a buffer of 4 years, if you're simply $100,000 is your retirement income goal. If you have a buffer of $400K, 4 years, then you're permitted to distribute your equity assets at 6% distribution rate. Follow that? So if you have $400,000 of cash value life insurance at retirement, $400K of cash value life insurance at retirement, then you have 4 years of buffer provided your income goal is $100,000 per year. Okay? If you have that buffer, then you only need $1.66 million to generate $100,000 of lifetime income, right? That's a 6% distribution rate on $1.66666 million to generate $100,000 of lifetime income. And this is what we're focused on today. If you're using the Monte Carlo withdrawal rate system, all equities, all bonds and equities, this is the no diversification piece of our spreadsheet. 3% distribution rate. You need $3.3 million to net the same 100K. That's a hell of a lot more savings than you needed in the volatility buffer strategy. So if you're stretching clients' assets into maximum income with more predictability and better guarantees with additional tax-favored treatment, having the buffer asset is far better than not having the buffer asset. Here we go. I'm going to keep going. There's a piece, very simple concept. It's a great one-pager to use in describing the concept to clients. You have $1 million of assets at retirement with a 3.5% withdrawal rate simulation. You're going to grab $35,000 of non-guaranteed income. If that $1 million asset was split in between $750 of equities and $250 of cash value with a $750,000 death benefit, we want to try and match. There's some mathematical, there's math goals here. We want a 1-to-1 ratio between equities and permanent death benefit that also carry a significant amount of cash. At a 6% distribution rate on $750,000, remember, it's not the amount of assets you need, it's the distribution rate you're permitted to take from them. You're actually grabbing $10,000 additional more in retirement income off of less assets, or fewer assets, we should say, because you have that buffer. Remember, the buffer is the permission slip to spend down at 6% versus 3.5%. To keep it moving here, we're approaching 12:30. A couple more pieces. Hey, I don't know if you've turned on the news, but the bond market is in trouble, right? This further proves concept that we do not want to retreat from equities at this point in time. Arguably, it's a buying time, not a selling time. We do want to reposition 1/10 of your fixed income portfolio into cash value life insurance. If you want to be more aggressive and do 20%, 30%, 50%, whatever really floats your boat. But all our model's asking for is 10%. We don't want to mech our contract anyhow. So if your bond yields are really that bad and a premium deposit account is paying a higher yield than your bond rates, like U.S. Treasuries, 10-year Treasuries, like 86 basis points, then maybe a premium deposit account is a better solution, and you do want to move the whole thing. But it's easier for a client. It's easier to swallow on a client in a psychological and client behavior to take 1/10 of the bond or cash or fixed income equivalent and reposition to life insurance. And Lord knows there is a lot of money in bond funds, money market funds, GICs, right? There are a lot of cash equivalents out there. This further supports the distribution rate strategy. You see the 3% number has the highest probability, or about a 95% probability of your portfolio lasting 35 years into retirement. At a 4% distribution rate, you're somewhere around the 75% probability. But Lord knows, you start distributing at 5, 6, 7, 8, you got less than a 50% chance of making it. And one would argue, and I'll take you through this a little bit later in the slide, one would argue that the 4% and 3%, right, these models are outdated and inaccurate. So, in the flight to bonds, that is actually the worst thing you can do. You want to stay in equities. You want to reposition your bonds into cash value life insurance to create a buffer and insulate yourself from down markets. Here we go again. JP Morgan, you move the cash and you are in trouble. Here's the cash. You move the cash, you're in trouble. If you go from 40/60 to 20/80, you're also in trouble. If you maintain the 40-60 and ride this thing out at a 4% withdrawal rate, you have a much better chance of making it. So you don't want to get less aggressive. You actually just want to create a better buffer to insulate your portfolio. Heat maps, again, JP Morgan. Here's my logic between the 4% on the 4% rule. This is the head of Morningstar, right? They're pushing investments. They're investment driven. The 4% withdrawal rule is no longer appropriate. We cannot expect historical yield averages of 10% in equities and 5% in treasuries. Treasuries are so low. Markets, equities are so volatile. We cannot. The 4% rule was built on historical averages of 10% equities and 5% treasuries. If anyone's opened the Wall Street Journal, we're not even close to 5% treasuries. So the 4% rule is, in fact, outdated, and experts say 2.7% is the most appropriate distribution rate to use in retirement because of how low bond yields are currently. Not to mention, we got to fight the behavior risk. Buying and selling at the wrong time, psychological traps, triggers, guessing the market. You're never going to hit the top. You're never going to hit the bottom. And when you pull out, when you miss big. Because the average equity fund investor lost 9% in 2018, where the S&P only lost 4%. And that's because of behavior. That's trying to guess and trying to time the market. And again, this is JP Morgan sharing this information, not the insurance industry. 3 great resources to use. The Vanguard Retirement Nest Egg, that simulates the longevity of a portfolio if you're 50-50, 60-40, 80-20. And what it'll show you is that the more conservative you get, the lower performance or the lesser of the longevity. Fidelity puts out a great tool also. It shows withdrawal rates. So you show a 4% withdrawal rate, a 3% withdrawal rate, a 7% withdrawal rate, and what happens. And then lastly, what's really important is the longevity illustrator that's put out by the Society of Actuaries. That predicts, they'll ask you some very basic lifestyle questions like your age, your tobacco use, your decent health, and it'll predict how long you and your spouse are expected to live. So you can try and manage that portfolio when you get to the top of the mountain, out projecting how many years into retirement you're expected to live. So here we go with a volatility buffer. Just to recap, 3 types of buffers: a line of credit on reverse mortgage, cash value life insurance, and cash savings. Obviously, we're focused on number 2. I'm going to wrap this presentation up with ways that you can sell cash value life insurance literally from the comfort of your own home, no examiners, no paperwork, all e-capability. First premium payment can be through EFT form or credit card. There is no reason for you to have to leave your house in the midst of a quarantine, taking on additional risk in a public health crisis, when you can leverage the technology that we've actually organized for you in a very simplistic fashion to buy cash value life insurance. We are getting cooperation from carriers like we've never seen. $2 million permanent insurance, $3 million. One carrier is at $5 million. We expect a second carrier to announce $5 million. Non-med. We have a pilot program that we're working with 2 major companies. If there's an executive physical on hand within the last 18 months, $65 million non-med. Do everything from the comfort of your own home. Here's the buffer concept. If you took all distributions and you didn't have any buffer, here's you see the nosedive here. No buffer asset. This is for 30-year retirement based on the 4% rule from 1966 to 1995. Bad timing. Conversely, 1 buffer year. Skip 1967 and you have $1 million left versus running out of money. Skip 1970 at $850 left instead of running out of money. Skip 1975, which is a bad one, right? You pulled from the buffer, you have $1.3 million left. So you see the impact here. So as I move to closure and we're approaching 12:30, here's what I'm going to leave you with. A volatility buffer is cash value that provides liquidity for unexpected expenses and fluctuations of cash flow needs, right? We're using the distribution as a buffer to down market years, which allows the time for investment assets to recover. And here we go. I showed this slide to you before. This is so impactful to see as a visual. You cannot leave equities in these volatile markets. You gotta stay. You'll never guess the top and you'll never guess the bottom. So I'm going to wrap with just a couple pieces. Here we go. The solution: non-medical permanent cash value life insurance as a non-correlated asset. It doesn't matter which flavor. Everyone takes a pretty firm stance on low-cost IUL. Who's a whole life guy? Who's an IUL guy? It doesn't matter. Something with a floor. If you're going to use IUL, you can't have asset charges built into that policy with any more than 2%. I've seen 2% work. It's tolerable. We don't recommend any asset-based charge at all. The lower the charges, the more straightforward the product, the better. It buffs far better than having 6, 7, 8% asset charges, which quite honestly I think are ridiculous. Whole life is also a valuable tool. We'll illustrate it in whatever flavor you like. Here's a summary sheet on the left, summary sheet on the right, difference between IUL and whole life. We've built for you, as pertaining to the selling insurance from home, right on our homepage, lifebrokeragellc.com, you'll see a button, Agent Home-Based Toolkit. This gives you everything you need to literally sell anywhere from $1 million, I should say 500,000, to 65 million of life insurance from the comforts of your own home. Now, the $65 million program comes with a little bit of additional work, so I don't want to get everyone too excited, but accelerated programs exist up through $5 million all day long. Some involve even instant decisions. As you click on the Agent Home-Based Toolkit, it'll open up and you'll see step 1 is to sign up for IGO e-apps. Step 2 gives you a tutorial. We also have case managers that are willing to do one-on-ones with you, walk you through the sign up, get you acclimated to the program. Step 3 shows the accelerated underwriting. What carriers or products can you sell? And then step 4 speaks to the policy delivery, e-delivery, credit card payments, bank draft payment, you name it. Here's our accelerated list, right? You'll see product availability, underwriting at accelerated max face amounts, any state restrictions. New York's sometimes a little bit difficult, and if instant decision is available. If it's not an instant decision, which means like 2 to 10 minutes, you're looking at, if everything goes well, you're looking at a 4 to 7 day process. So I'm going to ask if there are any questions. Please type them in the toolbox. I do see one. Question is, and I'll read this, wondering if you have done any analysis on legacy values as a result of these strategies. Have seen Wade's at age 65 and 100. It would be nice to see if modeled out for 75, 85, 90. Yes, we do have residual death benefit calculations. We can model this through if there's applicable state taxes. Our software computes the detail of state estate taxes, federal estate taxes, IRD on qualified assets, and net to beneficiaries. So absolutely, and death benefit obviously is a wonderful legacy tool. A very, very good question. There are a few additional questions that I will take one-on-one. Given we're 5 minutes past the 12:30 mark, I want to thank you for your attendance today. We appreciate your business and your interest in our strategies. We're building about a dozen concepts that are somewhat in line with what we've just shown you, all surrounding income planning, qualified plan maximization, sequence of return risk. It's been a lot of fun to build out this content and exit this quarantine with more tools that when we hit the ground running, we're going to run faster than just about any other BGA in the marketplace. And we can't write any business without you, the producer, and providing you value on a daily basis. So we're excited to continue these webinars, showcase to you the tools that we're building, and any opportunity you give us to model through some of these software solutions is greatly appreciated. Everyone stay safe, stay healthy, stay in the comforts of your own home, and sell a bunch of non-med cash value life insurance as a volatility buffer. Be well.